Hi, welcome. This is Strategic Management Accounting, but it's really interesting. In this session, we're going to look at a brief review of job costing. Now, we're not going to look at the real detail, but really give you an insight as to we really need to understand costing. We know it's the end of low-cost China. We know it's the end of low-cost many other countries too. All right, let's not just pick on China here. But the big point here is that if you still need to understand costs, you still need to allocate costs. If you can understand costs, how they're derived, what are driving the costs, you allocate them in a proper way, then you can actually use reports for effective decision making about products, about which customers to work with, which activities to work with. And there's a lot of things you can do if you really understand how do we allocate costs. And that's what we're going to look at in the first half, the first 1/3 of strategic management accounting. Get into that cost side. That is just as strategic as the revenue side. So we need to be able to manage both costs and revenues in order to really have a fully profitable business. And there's so much that every factory can learn with a little bit of basic job costing, bit of cost allocation. So let's get into the good stuff, shall we? So I'm excited. We really need to take away the basic cost terminology, and there's several key points from the prior chapters that we're not going to cover in too much detail in strategic management accounting. Cost objects, they are responsibility centers, departments, customers, products. They are an object that costs are accumulated with, and so in some ways we can make responsible for, or in some ways we can use to determine some profitability, to know whether a responsibility center is actually being useful, value adding for the organization or not, to know whether a customer is being value added or not, to know whether a particular product that you're making is being value added or not. So cost object is the object of the cost allocation. Direct costs and tracing. We must also understand that in a product manufacturing, materials and labor are the big direct costs. That is, you have people working on the factory floor. They are direct costs. When they stop working, then their wages, okay, they're still direct costs, but when you fire them, they're no longer your direct costs. So if they're working on the factory floor, they are your direct costs. They are direct costs of actually assembling the product that you are making. Of course, materials are a direct cost. Direct costs are very easily traceable to products. Keep that in mind, direct costs. Indirect costs are about overhead. They are about the factory supervisor that is looking over the factory. They are about the administrator. They are the utilities, the electricity bill, the water bill that the factory encounters in order to make something. And so these indirect costs are not naturally directly allocated to a product or a customer or a supplier. These indirect costs need to be allocated through a particular decision that you make, an allocation method. And what we're going to go through in more detail in this semester is the activity-based costing allocation method, which actually fine-tunes the actual causality of using overhead and actually making a product. Under basic job costing, we do a basic allocation based on machine hours, based on square foot of factory space, or some other plant-wide method. And as products increasingly use more indirect costs in their manufacture, for example, design costs, for example, the tooling manufacturing costs, these indirect costs become much more greater portion of the total product cost, and so therefore the allocation of these costs to different products, if you're making multiple products, become even more and more important. So keep that in mind. There are direct costs, very easy materials and the direct labor that you employ on the factory floor, and then you've got the indirect costs, overhead, that are increasing over time as products become more sophisticated. So we need a cost pool. That's a logical grouping of any cost objects, like a bundle of products, like a particular customer segment that we may allocate costs to. And we have a cost allocation base. That is the cost driver that is used, the basis upon which to build a systematic method of distributing indirect costs. As I mentioned, machine hours is a really good cost allocation base. As you run the machine for longer, then you get to allocate the same portion of overhead over a greater range of products. That's why a lot of factories in Shenzhen, just across the border in China, like to run double shift. Foxconn, for example, making the iPhones, they like to run double shifts. So therefore the factory costs, the buildings, the electricity, the water, the machine investment can be allocated over double the range of products that are produced. You can see that. So therefore the individual overhead per unit is actually smaller per product, and therefore you can make a greater margin per product when you sell. So keep this in mind. We've got the cost pool, that's a logically grouping of related cost objects, and then we've got a cost allocation base. So we use machine hours. Do we use square foot space of the factory? Do we use machine investment, or do we use material costs? For example, in the jewelry industry, you may allocate more costs to gold bracelets than you do silver bracelets. Why? Because the gold is worth more, and that's an example of allocating on material costs. So there you have it. These are really big points that you need to understand with cost terminology. We've got cost objects, we've got direct costs and tracing, we've got indirect costs, we've got the cost pool and the cost allocation base. So we'll see you in the next session where we actually go through an actual job costing example to understand how allocation of costs can actually improve the accuracy of your decision making. One more thing we need to understand here is that there's basic job costing and there's process costing. And so for the most part, most students get exposed to, when you're working for a company, to job costing. And especially as service industries expand, generally the service isn't the same for every customer, and so that is costed per job. When you work for an accounting firm, you are doing job costing. You work so many hours on a client, then you bill the client for those hours used. That is job costing. That's what I mean by job costing. That is allocating to a job, and the job is the cost object. Where, and this is specifically important, where jobs are different. Under process costing, we have similar products. For example, oil refinery, orange juice, soda pop. These are similar products. Basically, you're making a liquid. You're making a liquid product. So therefore, you can actually use process costing to allocate materials, labor and overhead to work out the actual cost per litre, the cost per gallon, okay, or the cost per pint, or the cost per however you measure these things. So understand that there are two different costing systems, job costing and process costing. When we move to a more advanced stage of costing, that activity-based costing, we're really focusing on job costing, not process costing, for the allocation of activities that actually cause costs to occur. We can have a look at different cost systems that are illustrated under job costing and process costing. And you can see that, as I mentioned, in the service sector, a huge area sector of many economies around the world now, and so audit engagements, consulting engagements, IT engagements, merchandising sector, that is retail stores, sales promotions, and you've got examples here of LL Bean or Walmart, great. Manufacturing sector, assembly of individual aircrafts at Boeing, construction of ships at Litton Industries. These are jobs. You might think that all Boeing aircraft are the same. Well, to some extent, but they are individually customized to different airlines, because so some airlines now in the Boeing 777 will have 10 chairs across. It's very not much room, whereas originally the original configuration was 333, but now some airlines are going 343, just like 747, but they squeeze it into a 777 airframe. That's customizing the job for a particular customer, so that's still job costing. Under process costing, we can see that some of the bank activities, postal delivery, grain dealing, that is the primary produce, where every grain is basically the same, so you're just selling the grain by the ton, or dried fruit, you're selling the fruit by the ton. All right, or we got oil refining by Shell, oil beverage production by PepsiCo, where you're just selling liquid, and basically it's by the litre or by the gallon, depending on which country that you're in. So we have actual costing and we have normal costing. This is really interesting. This part here, students don't always get, because they're thinking, oh, we should do actual costing, actual. That's the only way we're going to have a accurate version of the cost when we wait for the actual cost to occur. And then we can allocate the actual cost to the product, and Bob's your uncle, we can work out the exact profit. Great. But the problem is you have to tell the customer a price before the customer buys. And ideally, in your profit planning, in your strategic plan, you need to have some idea of a profit margin. And so actual costing will not be able to give you that profit margin. Why? Because you have not sold the product yet. So here's the deal. What a lot of companies do is use normal costing. That is, we are allocating pre-planned cost, especially materials, labor and overhead, to the product, and so we can, before we sell the product, work out how much does that product really cost us to make. Then we can work out, okay, we can add on distribution, shipping and freight, and then we can work out, okay, in the retail store, what is that profit margin? How much are we making on this product? And so you can work out beforehand, before you commit to shipping, before you commit to production, before you commit to actually going with a particular distributor is taking 15% of that profit margin. Before you commit, under normal costing, you can allocate and actually predetermine the actual profit you're likely to make for every product sold. And so that's the big difference between actual costing and normal costing. Get the idea, get it from a decision-making standpoint. Don't just think about the mechanics. Oh, normal costing. Do we have standard costs or do we have a standard overhead? Which one do we use? No. Step back from that. What is the decision you are trying to make with this costing method? And the big decision is profit planning. It's about pre-production planning. It's about full strategic planning about what are you going to make, how much are you going to sell it for, and how much money you're likely to make if you go down this road. Normal costing can help you with that. Actual costing will not. Actual costing gives you the exact costs it costs you to make after the fact. Of course, after you've got into the normal production runs and you're into multiple iterations of making and selling, now you can bring the actual expenses in and compare against your normal allocated expenses to really find out, are the costs really the same as I thought they were going to be? Now you can get feedback from your actual costing. But the actual costing doesn't help you at the beginning. It helps you in the feedback later on, where you compare your actual costs with what you thought the costs were likely to be based on predetermined standards. You see what I mean? So actual costing and normal costing can help, but really at the beginning of the process, normal costing is what's going to give you the best decision information that you need for profit planning, for strategic planning, for going into a particular production product run. Okay, but after you get moving, it's the actual costing where you do an allocation so you get feedback on your original allocations, and you look at the variances, and then you're going to find out, we really underestimated the material costs. We really underestimated the labor costs. And then you can go back and really think about, do we still want to continue with this strategy? Or is there some way operationally we can improve the material costs, or the labor costs, or the overhead costs? So both actual costing and normal costing are important, but important at different stages of the product production and sales life cycle. Catch you in the next slide. So we have the costing approaches summarized here. And we've got actual costing, normal costing. These are the actual mechanics. But first, understand why you're doing it. The why is so much more important. Here is the how with the slide. I don't want to bore you with the how, but basically with normal costing, we've got to try and get a predetermined rate if it's just overhead, basic normal costing, or standard costing where we have a predetermined rate for materials, labor and overhead. Then we need to allocate that accordingly. There are mechanics there, you can work that out, but when you get the why, you understand why it's important to actually understand the mechanics of normal costing. So we have a 7-step job costing. Here's a 7 steps. If you really want to go through this, you can, but number 1, identify the job that is the chosen cost object. All right, so we're making an iPhone. Okay, that's a job. Identify the direct costs of the job. Well, we've got materials, we've got people, we've got 90 different steps in the assembly, and we've got people along that assembly line, 90 plus people in that assembly line. Wow. So we've got to pay them labor, so that's direct costs. There are materials, that's direct costs. As you can see, we identify direct costs. Select a cost allocation base to use for allocating direct costs to the job. Indirect costs, so the indirect costs, something like could be supervision, could be administration, water, electricity, then to run the machines. What about machine investment? What about the conveyor belt? The investment in the conveyor belt that makes the iPhone, as it's getting slowly produced, assembled, goes from station to station. Okay, you have to pay for that conveyor belt. That's not direct, because that will last several years, you see. So you've got to allocate the cost of that conveyor belt to each phone that actually goes along the conveyor belt. Yes. So these are all indirect costs. We need to think about how we would allocate the allocation base to the job. So we can allocate all of these in terms of a per unit made every day, or we can make it a better allocation method could be in terms of how long the production line has been running. Okay, so it runs for 6 hours in a shift. Then we can use that in the total hours of the week, maybe 12 hours times 7, 84. Yes, I can do calculations. So 84 hours in a week, and we can get total cost of machines that are allocated over that year. 84 hours a week times 52. If the machine just lasts for 1 year, so we've got 84 times 52, that we can take $1 million machine divided by 84 times 52, 52 weeks times, yes, and there you go, your total hours there, and then you somehow get a rate so you can allocate your machine costs to the production of the iPhone. So this is the mechanics of how you're going to go about it. But what's important now is to think about the cause and effect. It's cause and effect. What causes a cost to occur? You cannot make an iPhone if you don't have a machine. So the cost, the investment in the machine causes an iPhone to be made. But the big problem here with indirect costs is how do we allocate a machine to the iPhone? Okay, and so machine hours is a very common way of allocating costs to the manufacturer of an iPhone. All right, so we don't have time to go through all the calculations, but you can see the numerator is basically the total cost or fixed cost of an overhead, like machines, like supervision, like electricity, like water, and the denominator are the hours that the machine is running, if that is the basic cost base. So we want to identify the indirect costs associated with each cost allocation base. Then we can compute a rate per unit for each cost allocation base used to allocate indirect costs to a job, compute the indirect costs allocated to a job, and then we can compute the total cost of the job by allocating all indirect costs assigned to a job. So there are a lot of steps here, but the most tricky part is deciding what is your allocation base, because once you've decided that, you can put everything else into a spreadsheet and do the allocation of the costs to the job. And so we have a sample job cost document here. I won't bore you with the detail, but here we've got direct materials, direct manufacturing labor, and manufacturing overhead, and we have the total cost of the job. As you can see, for a particular customer, there is different quantity of different parts being used. There are different hours of different employees being used, and there's an allocation base for manufacturing overhead. And we use in the allocation base, what is it? Direct manufacturing labor hours. That is the case in this case. Like I said, we could be using machine hours, we could be using factory space, Or we could be using materials costs. They are common bases that are used to allocate costs, allocate indirect costs to particular jobs. And so we can have the job costs here. The total cost of the job is $3,960. The big point to note here is, how did we allocate overhead? Have a look at that. We have a cost pool category that is a pool where we actually accumulated all of the manufacturing costs. We have an allocation base. We made a decision that's going to be direct manufacturing labor hours, number 2. Then we find that the manufacturing hours for a particular job is 88 hours. So now we multiply the 88 by the 45. Where did the 45 come from? That is basically the cost pool category. Cost pool category, that is all of the costs accumulated under manufacturing, divided by the direct manufacturing labor hours for a particular period. Maybe it's for 1 year. And so we get an allocation base rate of $45. And so a job runs for 88 hours. So we multiply that by 45, and then we're allocating $3,960 to that job. And that is the most tricky part of job costing, working out the allocation base and then allocating it to the particular job, finding out how much of the allocation base did the job use. We have various job source documents to find out where does the cost come from. These are material costs source documents. And then there we have the job costing overview. And as I said, we're allocating a total of 27,000 direct manufacturing hours as the denominator. And we've got all these costs of $1.215 million. We divided by that 27,000 and we get that $45 per unit. And then we use that to allocate that to particular jobs based on how much actual manufacturing hours a particular job used. And so we have the flow of costs where you're purchasing materials, you've got your overhead, they are traced. The direct materials and labor are traced to a particular cost object in the work in process inventory. The actual manufacturing overhead is actually allocated into work in process inventory, and then it's converted into finished goods inventory, and then when sales occur it goes into cost of goods sold. These are your basic debits and credits that go through your balance sheet and into your income statement. We're not going to go into that detail in this semester, but just keep in mind that there's all these mechanics in the background that allow us to put what we see in the factory into your balance sheet in the financial statements and income statements. So that's a wrap for this first part of job costing. I'll come back in a minute where we actually go over a real example to understand why allocating costs can help provide value added to the decision-making process in the organization. So catch you in the next session. Thank you.